Chapter 3, Adjusting Accounts and Preparing the Financial Statements. Again, accountants divide our time period into a variety of time schedules. Quarterly, monthly, as you can see, semi-annually, and annually. The quarterly and the annually, obviously would be also semi-annually, for publicly traded companies is required by the Securities Exchange Commission, more commonly known as the SEC. Monthly tends to be more of an internal documentation, so their formatting can be a little bit different in their rigor here. First thing we got to get used to is accrual versus cash basis accounting. Up to this point, we've been sort of treating everything on a cash basis, and both are used in practice. And actually businesses have a choice until you do get to public, because in GAAP only recognizes accrual accounting. But a lot of businesses don't care about that. They'll go on a cash basis. In fact, you personally, as well as most taxpayers, or at least individual taxpayers, operate on a cash basis. You just sort of record it when cash is received and when you pay cash. But that's not true for GAAP. GAAP only recognizes accrual basis accounting. So what are we talking about? Accrual is you recognize revenues and expenses when incurred, not when paid. Here's the difference, is when cash isn't paid. And there is a legal difference, and it can be quite substantial, actually. Let me get into this. So again, GAAP only recognizes the accrual basis. This is what we're going to be studying from this point going forward here. I'll give you an example here. Is on December 1st, this company paid $2,400 cash for a 24-month business insurance policy. Using the cash basis, you would write that whole $2,400 off right then and there as of December 1, 2013. And there would be no insurance expense. Whereas GAAP would recognize this on a monthly basis. You would take $100 of it this month and recognize it for each month for those 24 months. And this way you're matching the expense to the benefit period of the insurance coverage. This cash basis, by the way, you're going to find still used by many businesses. There's some advantages to the cash basis. For instance, farmers. You'll see a lot of the automobile companies giving sales around October, November. That's right after harvest, when a lot of the agriculture industry is flush with cash. And if they've had a great year, a lot of times companies will want to accelerate their equipment purchases because they can expense it versus depreciate it. And it can lower their taxes. So from a tax basis, cash basis gives you more room to, I don't want to use the word manipulate, but to adjust accordingly to your income. And hence it's preferred. But it's not recognized by GAAP, it's not recognized by the SEC, and as more companies grow and bankers start requiring GAAP financial statements, they'll then have to switch to that, and especially if you go into the public markets here. Recognizing revenues and expenses. Now we're getting into the revenue recognition principle and the matching principle again for expenses here. And when do you recognize this as a revenue or as an expense? And like I said, I always said it was based on the legal incurrence. What defines that? Again, this is both recognizing revenues and expenses. And when I say it's when the legal thing was incurred. So, for instance, it's not when let's take a customer and they order the product. They might have even prepaid that product for that product. That is not when it was legally incurred. Legally incurred is when you were actually delivered on that product. Again, not when ordered, not when billed, not when paid, but upon delivery on that. And there can be quite a lot of adjustments, and there's some problems in this. For instance, the trucking industry does not like to make a lot of deliveries in the last week of the year, because sometimes businesses simply lock up their doors, won't accept a delivery because they don't want to incur those payables as recording it, so they refuse delivery. And because of this, much of the trucking industry refuses to deliver unless it's been prepaid, or from that standpoint. So we're going to get into this more as we get into accounts receivable and later, but I just want to introduce the concept now that time becomes a very important concept. Framework for adjusting. Now, the adjusting entry is recorded to bring an asset or a liability account balance to its proper amount. And what happens is that amount changes over time. And again, time becomes the ingredient that we have to reflect here. Again, we might have paid or received cash, but when is it actually recognized? Both on the expense and on revenues and so forth. And so we're going to go into the accrual basis here. And it also will now bring up another component for like equipment. This includes depreciation expenses. So, prepaid or deferred expenses, resources paid prior to receiving an actual benefit. For instance, insurance would be a classic one. You pay, typical for a lot of people, they buy their car insurance maybe for 6 months, and you would just simply write a check. Well, in the accrual basis, you will actually record that as an asset, and then you'll start expensing it. And that asset could be the prepayment. It could be prepaid insurance. You do own it, and then you'll start decreasing that amount every month. And here we have, for instance, prepaid insurance. And so, and then we have the insurance expense. And it'll be an offsetting from both a balance sheet as well as an income statement. And what you're adjusting is both the balance sheet and the income statement. So all adjustments will have one, a balance sheet item, and two, an income statement item. And usually it's an expense item on there. Supplies is an example. You bought a whole bunch of supplies. Here they said you had 9,000 recorded, and then you make a count of your supplies, and yours 8,000. So it means you used up 1,050 of your supplies were used during that December. So you have to adjust, and what you have to adjust is your supplies on hand down, and then the corresponding offsetting transaction would be to expense it. And so you decrease your supplies by the 1,050, and now you debit your expenses. Again, balance sheet and income statement. There are other prepaid expenses that you should become aware of, like prepaid rent, insurance, supplies. There can be quite a bit that companies has. There can be also deposits on hand and so forth. And we are always going to be adjusting these for the passage of time, typically at the end of every month, definitely at the end of every year. Depreciation. Depreciation is the process of allocating the cost of a plant asset over its useful life. And we do this in a systematic method. So, for instance, you bought a large, let's say a truck for your use, and that truck is planned for 5 years. Well, on the cash basis, if you paid cash, you could expense that truck that year. Not with the accrual basis. You have to spread the cost out over those 5 years. And there are a couple components and you're going to have a full depreciation much later in the year, so get comfortable with this now. And so you're going to have a couple things you have to look at. You have to look at your cost of that asset. You subtract any salvage value. Sometimes you might be able to sell it for the metal or the junk value, and it'll always have a residual value. Well, you subtract that value out to get a depreciable level, and then you take out that useful life and you divide it. So if it's 5 years, you would do it by 60 months. And then you can write off or expense that over the 60-month period. And this is used extensively. Here they're giving an example. You bought equipment for $26,000. You expect to be able to sell the equipment at the end of its life for $8,000, and you're going to depreciate it over 48 months. So you just take the 26 minus the 8. You have 18,000 divided by 48. You're going to write off $375 per month. And so you have this depreciation expense, and you will name the equipment in the title. And notice we have accumulated depreciation expense. This is what's called a contra asset. It's a corresponding to that actual asset and starts decreasing the value of that expense. So notice we now have 3 ledger accounts. Equipment, what you paid for it. You have depreciation expense that you're going to record every month. And then you're going to accumulate this depreciation in this accumulated depreciation account for every month that you're expensing it. So you're creating this account in your chart of accounts to keep track. And then later on, you will subtract the balance of this value from here to get what is called the book value of the equipment. And that is what you will show on your balance sheet. On your balance sheet, you will actually show the cost less the accumulated depreciation to get your net book value. Here's an example of how it would look like on your balance sheet. You have equipment always at your cost. Now we have 1 month's depreciation. Hence, we'll show it on the value at the book value. On the balance sheet, you must show all 3 things: what the cost, the accumulated depreciation, and then the net value. And that will go into your total assets. Again, let's look at this revenue and expense recognition. When do you record it as an actual revenue or an expense? And again, it's not when the customer orders it, it's not when it's billed, but when the service is performed or the product is delivered. And that becomes very important. For instance, revenue recognition. This concept has significant abuses in the industry. And I don't think the textbook talks about that. So I'm going to start that with the next video, because I'm running out of time here. But I'll start with this about you need to be aware of the problems that this creates in the industry. Thank you.